Hello and welcome again to episode 6 of the Lifespan Investment Series. Joining me again is Lifespan Investment Committee member, author, and publisher of the Payne Report, Jonathan Payne. Jonathan, welcome.
Hi, Eugene. How are you?
Yeah, very well, thanks, JP. So let's kick straight into it. We want to talk about what's happening from a geopolitical instability point of view, starting off. And boy, oh boy, is there a lot happening at the moment. You've got the US election coming up in about 3 weeks. You've got unrest in the Middle East. And then you've got interesting tailwind of economic policy happening over in China. And then we want to talk about, and then we've got an election year next year in Australia, which is, 6 or 7 months away now. So the Australian politicians will be on the election campaign as we speak, essentially. So there's a lot happening there. Let's start with the US and the election. Jonathan, I know you've been doing an incredible amount of analysis. What are your thoughts leading into the finish line of that? What are your thoughts now?
Yeah, well, Eugene, you're absolutely right. We've got a lot of ground to cover today. Some incredibly interesting, exciting, and I think very, very important events on the horizon. First and foremost, of course, we have Tuesday, the 5th of November in the United States. This is going to be the most important election of our lifetime. And there is only one election in the world that affects every citizen in every corner of the world. And of course, it is the United States. So now we're in the final furlong. It looks like Trump is gaining momentum just in the last week or so. And in the latest weekly Payne report, Eugene, I did say that I believe Trump will win on Tuesday, the 5th of November. If we go back just a month ago, Harris had the momentum following a very successful debate performance when Trump and Harris had their debate about 4 or 5 weeks ago. She got quite a lot of momentum out of that, but it would appear that in the last week, perhaps 10 days, Trump is nudging ahead. The betting markets now have Trump as favorite, and a composite bookmakers odds tracker, which is a composite of 5 bookmakers, has Trump at around 54% chance of winning, with Harris at about 44, 45%. Let's just very quickly go through the electoral calculus. We all know that it's all about the electoral college in the United States. It's not about the popular vote. And basically, the winning candidate needs to secure 270 electoral college votes to win. We also know that there are 7 key battleground states that really determine the outcome. Why do we know that? Because, of course, big states like California, we know we can put them in the Democratic column, foregone conclusion. Similarly, states such as New York. However, then if we go across into the battleground states, the most important one of them all is Pennsylvania. I have long believed that the road to the White House runs through the state of Pennsylvania, which has 19 electoral college votes. And just in the last week, it looks like Trump is just nudging his nose ahead of Harris. Even in Michigan and Wisconsin, 2 critical battleground states, 2 or 3 weeks ago, Harris was clearly ahead there. Now Trump is either even with Harris or slightly ahead in some of the polls. And then we look at states like Arizona, where I think Trump is ahead, Georgia, where I think Trump is ahead, North Carolina, which I think Trump is ahead in, Nevada arguably goes Harris. As I said, Wisconsin and Michigan, even Stevens, but I'm now suggesting that Pennsylvania goes Trump. And that leads me to believe that Trump will be the next president of the United States. The other critical issue for us, of course, is the composition of Congress. There, the Republicans are fairly heavily favored to take or regain the Senate. Absolutely critical. The House of Representatives, I think, is too close to call. It's really 50-50. That could go either way. But at the end of the day, we do know that this election in the United States is arguably the tightest race we have ever seen. We also know in just the last week or so, we've had two very, very large hurricanes batter the southeast of the United States, hitting Florida, Georgia, and also North Carolina. Now, we're not quite sure how these hurricanes will play out in terms of the politics around those hurricanes. Also, we have, of course, this very, very major escalation and conflict in the Middle East, which we'll touch upon later in our conversation. But suffice to say that these two events, the unrest, the war in the Middle East, and also the major hurricanes, can tip the balance in these final 20 days or so. The other factor, which is very much a kind of random factor, is, of course, Elon Musk, who appeared at a rally with Trump in Pennsylvania, and he is clearly, obviously, endorsing Donald Trump. Elon Musk has a massive following, particularly in terms of his social media accounts, but also just generally across the United States. And so maybe there's a bit of a Musk factor coming in here in the last 7 or 8 days. But look, the bottom line is I have now decided, after much procrastination, to suggest that Trump will win. If you recall, when it was Trump up against Biden, I said it was a fait accompli. It was a done deal. Trump would easily beat Biden. The Democrats obviously agreed with that, and they replaced Biden with Harris. I initially thought that the momentum was with Harris, and there would be a lot of energy and excitement around Harris as a candidate. That now seems to be dissipating. That kind of momentum and enthusiasm for Harris seems to be falling away, and Trump now seems to be the favored candidate. In terms of what does that mean? At the end of the day, what does that mean for the world financial markets? Neither candidate, neither Trump nor Harris, has expressed any kind of fiscal discipline. At the end of the day, the budget deficits and the huge levels of US government debt will continue to rise regardless of who wins. On balance, however, Trump's policies are arguably more stimulatory in a fiscal sense. And of course, we've got his much beloved tariffs, which are inflationary. So a Trump presidency would be more inflationary and also serve to increase levels of government debt. In terms of equity markets, if we use 2016 as a playbook, what happened when Trump won in November 2016? Well, we know what happened. Of course, smaller companies performed very, very well. Smaller company business investment sentiment improved noticeably because Trump obviously initiated less regulation and lowered taxes, and of course elevated general sentiment in the smaller business sector in the United States. So the small cap index, RTY, the Russell 2000, performed very well, and I anticipate something similar if Trump wins in a few weeks' time. So net, that's my bottom line. Much too much procrastination with a great sigh of relief. I'm going to try and turn my brain off now as we head towards these last few weeks. I've spent way too much time on the US election. I need to spend more time now on China and Middle East and other things. So that's my bottom line, Eugene.
Thanks, Jonathan. Yeah, it is going to be a close one, but that's interesting analysis. And in terms of what it means for markets, well, and yeah, I guess it's important to understand that whoever wins, we're still going to have a debt issue in the US, and I don't think that's going to come to a head anytime soon anyway. But it'll be interesting to see where that ends up medium and longer term. But you mentioned China and the Middle East, and look, it's really unfortunate what's been happening in the Middle East. Interesting to talk about that and to hear your thoughts on that, as well as how the conflict in the Middle East may influence the US election, and potentially, because of the upcoming US election, what pressure the US government may be putting on Israel in terms of their response to the attack from Iran.
Yeah, absolutely, Eugene. Look, this is an area of real interest for me. I lived 9 years in the Middle East, and I love the region. Traveled very extensively when I lived there for 9 years. I've returned many times to the region. I've studied the region now for nearly 40 years. I have a really strong passion for its history and have enormous interest in the politics. So let's just take a very brief step back. Very recently, Iran launched nearly 200 ballistic missiles at Israel. That's the largest ballistic missile attack in the history of conflict. Israel is going to respond, and it could respond while we're actually conducting this conversation. It is imminent, but there is no doubt that Israel is going to respond. And what I've been trying to do through my pain reports in the last few weeks is to think about the potential scenarios and the potential targets, because that's going to be critical. But the bottom line is this. My primary message is that both Israel and Iran have both put their feet on an escalatory ladder. And we don't know how high up that ladder both these nations are going to travel. But we also sadly know what is at the end of that ladder, and we don't even want to have that conversation. Yes, the United States, you're absolutely right, Eugene, is putting huge pressure on the Netanyahu government as to how they respond to the Iranian ballistic missile attack. So in terms of the potential retaliation by Israel, Israel has certain targets, potential targets in Iran, and they are as follows. Clearly, there's the military installations and infrastructure. They could target the ballistic missile sites. There's also another option that Israel targets Iran's oil infrastructure and installations, and there the target is very straightforward, because 90% of Iranian exports come out of the Karg oil terminal, which is located on the Karg Island, which is in the northern part of the Persian Gulf. And Karg Island is obviously an island off the coast of Iran. Extremely easy target for Israel to hit. And it would, of course, have devastating economic impact upon the Iranian economy. As I said, 90% of Iranian exports come out from the Karg oil terminal. Now, the Biden administration are particularly keen that the Israelis don't hit the Karg oil terminal because, of course, we have an election in the United States, and they don't want to see a sharp rise in gasoline prices on the eve of an election. So there's obviously a lot at stake here. And then, of course, the kind of almost worst case scenario in terms of retaliation is for Israel to target the Iranian nuclear installations, which are very dispersed right across Iran and also at very great depth. This is by far and away the most complex bombing mission for Israel. And it is my view, with many other military experts, that Israel couldn't do it on its own. They'd have to use the United States. There's a couple of things. Number one, the bomb, the so-called bunker buster bombs, are made by the United States, and only a US aircraft had the delivery mechanism. And moreover, Israeli Air Force jets would have to refuel on the way back, and they'd probably have to be refueled by US aircraft. So it's a much more complex mission, and I think that is a fairly low possibility. Then, if you really want to carry on this so-called escalatory ladder, and there's plausibility to every rung on this escalatory ladder, the kind of doomsday for the oil market is, of course, Iran responding by closing the Strait of Hormuz, which, as you know, is the choke point at the southernmost end of the Persian Gulf, through which 20% of crude oil every day. And don't forget also the very large natural gas exports that go through that area as well, that come primarily out of Qatar. So any closure or threat of closure of the Strait of Hormuz, and the oil price, Eugene, would trade at $100 in the first second, then $120 after 15 seconds, it would be devastating. So these are the potential targets that Israel could have. Obviously, highest probability against military installations, though I do note that the Israeli defense minister recently did say that it's going to be a very significant attack and it's going to surprise everyone, which I'm not quite sure what that means. So the bottom line is we are literally on the edge here of a further escalation in the conflict. All the red lines have been crossed. For those of us who've studied the Middle East for many, many years, will know that the red lines were crossed in April when Iran first attacked Israel directly, and then Israel responded, but only in a very limited and surgical attack on anti-aircraft radar systems outside of Isfahan. This attack Israel is going to be far more significant. And we also think that Iran will respond to this new Israeli attack. And that's why we talk about this escalatory ladder. And obviously, many, many parties are trying to prevent Israel and Iran, climbing ever higher on this escalatory ladder. I'll leave the conversation with just a couple of observations. I listened to all of the speeches by the Israeli Prime Minister Benjamin Netanyahu. I follow every coming out of the cabinet and out of the government. I've seen all the speeches. I've also been following all of the public statements made by Ayatollah Ali Khamenei, the leader of Iran. Neither of these individuals, to me, show any signs of stepping off that escalatory ladder. And I do believe that much of the world is underestimating the resolve of both these leaders to escalate this conflict even further. I'll leave it there.
Yeah, it sounds like this has been building for some time. All right, well, and it sounds as though there's lots of different ways it can go, and it'll be a step-by-step process, and the next step will depend on how the other side reacts. So, yeah, but it's a very unfortunate situations which will have significant cascading impacts on the rest of the world. Let's turn to something perhaps more positive, which is China and the recent government announcements that they're looking to stimulate the economy, in effect, and how this perhaps wasn't that expected, despite the fact that the Chinese do like to stimulate when they think it's the right time. Can you give us some insight into that and what you think the impact's going to be from that?
Sure. Yeah, absolutely. This is, I think it is big news, and it is also significant because we've kind of been waiting for the Chinese government to admit or acknowledge that the economy was in serious trouble. I mean, we all know where this started with the bursting of the Chinese property bubble 3 years ago. And since that time, we've just seen a continuing worsening in the property market in China. And the property market is such an incredibly large part of the economy. Anyway, I think I'm right in saying on September the 21st, the relatively new People's Bank of China governor, Pan, P-A-N, basically did a Draghi. You remember Mario Draghi in what was it, June or July of 2011 said, we'll do whatever it takes to save the euro, and believe me, it'll be enough. Well, Governor Pan, at a very hastily arranged press conference, announced a whole series of stimulatory monetary measures, which were really, really quite significant. And so we all kind of got quite intrigued by all of that. However, what we also know is that China needs fiscal stimulus. It's all very well having monetary stimulus, but as the very eminent British economist John Maynard Keynes described as a liquidity trap is where borrowers don't want to borrow and want to lend, very analogous to what happened in Japan. in the 90s. And China arguably has entered a kind of Keynesian liquidity trap, and a liquidity trap characterized by deflation as well. So this weekend, and I'm sure all of you spent your weekend waiting for it, the Minister of Finance, the Finance Minister, unveiled the missing piece, the missing fiscal piece of this economic stimulatory jigsaw puzzle. But it was a little bit disappointing, I'm afraid to say. We need to get a little bit more detail. We wanted a more explicit fiscal stimulus package. The finance minister, however, basically said, yes, they're going to stimulate. Yes, they're going to tolerate a higher budget deficit, which is currently kind of limited at 3% of GDP, budget deficit 3% of GDP. But now wait for the Politburo to have further discussions at the end of the month. So, as we speak, I haven't yet seen the opening prices in some of the Chinese equity markets, but I think the market's going to be a bit disappointed. But I think what we can say, Eugene, is there's a growing realization, particularly a growing awareness by President Xi Jinping, that yes, China is in trouble. Yes, there are deflationary forces. The property market is very seriously weak, and the government needs to step in. The central bank has provided lots of monetary stimulus. Now the government needs to provide fiscal stimulus. We got an outline, an overview of potential fiscal stimulation, but we didn't get the nitty gritty. We didn't get the real explicit detail, which we hope is forthcoming. But the bottom line, and return, as you know, Eugene, to the Chinese equity markets, it was blistering. And we saw dramatic rises in Chinese equity markets, Shanghai, Shenzhen, the CSI 300, the Hang Seng in Hong Kong, and other various indices blasted off like rockets. And then, of course, came back to earth a little bit last week. And I suspect it's going to have a bit of a soft opening today because of slight disappointment as to the lack of explicit detail about this fiscal stimulus package.
That's the reaction of the local Chinese market. I think even if the stimulus is underwhelming, is it fair to assume that it's still likely to be a tailwind for global markets? Because I don't think any Chinese stimulus was priced in up until those events not that long ago. Would that be fair to say?
I think that's fair to say. So if you had asked me a month ago, did I think that Xi Jinping had kind of got the message and that Xi Jinping would authorize a significant fiscal stimulus? My answer to you a month ago, if you had asked that question, would have been no, probably not, because Xi Jinping has constantly said, basically, that's not what he wants to happen. But I think, and what we saw just in the lead up to the 21st of September were a number of former very senior policy advisors who went on public record basically saying, China needs to change its ways and the government needs to respond to what is a deepening property crisis. And also, as we know, business and consumer confidence in China has been near rock bottom now for a number of years. So it looks as if the advisors have finally got through to Xi Jinping, and nothing will happen in China, obviously, without the president effectively signing off on it. So, yeah, I agree with you. The intent to increase fiscal stimulus has come as a bit of a surprise and has reignited some of the kind of animal spirits in the Chinese equity markets. And as you say, I think it's correct to use the phrase that this type of fiscal stimulus is a tailwind that wasn't there just a month ago.
Yeah. So we're interested to see how this plays out, but obviously it's impossible to know how much of a tailwind, if any, it's going to be until we have the details. So that's something for us to keep an eye on. Okay, so that was an interesting discussion around the geopolitics of the world. A lot there and a lot for us to keep an eye on over the coming weeks, days, months, etc. Let's now turn to US inflation, and we had some figures come out in the last few days. Jonathan, give us your thoughts on that, and also, what you think that means for interest rates and the likelihood of a recession.
Yeah, sure. Look, the CPI numbers in the United States last week were fractionally higher than the kind of consensus expectation. I don't think they were too kind of alarming, but in terms of what the market was anticipating, they were fractionally higher. The bottom line is we obviously had that fairly aggressive 50 basis point cut in the federal funds rate, which I was very lucky. I was actually predicting they would cut by 50. It wasn't consensus at the time. But basically, you've had a couple of economic reports in the United States, which has now made the market think about a recalibration of interest rate expectations for the remainder of the year. It now looks like the market is now pricing just an additional 25 basis points, followed by 25 basis points. And the 50 basis point cut, which the market was pricing 4 weeks ago, has now been taken off the table. And I think that's probably feels about right. So obviously the Fed kicked off its easing program with 50 basis points, very aggressive. And then we've seen, non-farm payroll was slightly stronger than anticipated, slightly warmer than anticipated CPI report. And that makes the Fed just take a little bit of a step back. And we've seen a bit of a repricing in terms of expectations for the federal funds rate moving forward. And also a repricing in the bond markets as well. We've seen 2-year note yields in the United States and 10-year note yields rising quite significantly just in the last 3 weeks or so. And that's all part of this recalibration of Fed monetary policy as a consequence, as I said, of the non-farm payroll number and also that slightly warmer than anticipated CPI number. Just a quick caveat, and I've written about this in my reports extensively, and I think everyone's on board this now. But obviously, we saw that massive downward revision in the jobs numbers published by the Bureau of Labor Statistics for the period of March 23 to March 24. The Bureau of Labor Statistics say that the number of jobs during that period were revised down by 818,000. So when people kind of looked at the most recent non-farm payroll number, which was quite a bit stronger than anticipated, I kind of looked at it and went, do we really know what the number is? Because in 3 months' time or 6 months' time, they're going to revise these numbers. So I'm afraid I'm becoming a little bit cynical about the integrity and the quality and the accuracy of some of the US economic data. And I'll just put that out there, and I'm sure many of you will have seen that there's quite a lot of cynicism and skepticism now about the quality of some of the economic data. The bottom line is the Fed is going to continue to ease rates, but probably not at the same rate the market was anticipating 4 to 5 weeks ago.
And it seems as though, it would take a pretty severe uptick in inflation or jobs for the fact that we're still in an easing cycle to change. So it's just a question of how quickly and how far. So that's going to play out. Closer to home, in Australia, inflation continues to be a little bit more sticky, although it is sort of much more under control. What do you think is going to happen in terms of interest rates this year? I think some were predicting rate cuts in November. I'd say maybe there's a slim possibility, but I think everybody's suggesting that it's likely to be at the latest Q1 next year. What do you think, Jonathan?
Yeah, it's a tricky one, Eugene. I don't envy Michelle Bullock in this environment. I'm pretty convinced that the RBA would love to cut rates. I mean, everyone else in the world is cutting rates. The ECB has cut rates. The Bank of Canada has cut rates 3 times. US central banks cut by 50 basis points. Bank of England's cutting rates. The Swiss are cutting rates. Everyone's cutting rates. Of course, with the honorable exception of Japan. They're in a different monetary universe, of course. But look, it looks like we've run out of time for a rate cut in calendar 2024. And I think you're right, Eugene. I think we're probably going to get a rate cut in the first quarter of next year. I think you're right about inflation being sticky, and the sticky part of Australian inflation is certainly in the services sector. And the RBA governor constantly highlights this. And in her latest press conference following the last RBA decision, she spent a bit of time emphasizing the stickiness of service-based service sector inflation. So, there's the conundrum for the Reserve Bank. I think they'd like to be cutting rates, but they can't be seen to be cutting rates if their inflationary mandate hasn't yet been met. And the RBA is saying it's, their targeted rate of 2 to 3 is not going to be met until, kind of back right into 2025. So notwithstanding the very significant pressure that the Australian government is putting on the RBA, and there's a lot of question marks around that, which we may not get into today. But I don't envy the RBA in this situation. And as I said, I think they'd like to be cutting rates, but they can't be seen to be cutting rates. And certainly, I think the Australian government, quite frankly, is shooting itself in the foot, because every time the Treasurer goes on and on about the RBA, of course, the RBA can't be seen to be responding to political pressure because the RBA is independent. So I think if the Australian government just kept quiet for 5 minutes, the RBA might actually feel that they can start cutting rates.
It's very true. Like when you say the RBA can't be seen to be cutting rates, and certainly can't be seen to be bowing to political pressure, because they're not a political institution in a sense. They're supposed to be independent. They're supposed to make decisions based on, economic data and what's best for the country economically. And when you talk about not being seen to cut rates, I think the public would love rate cuts. But is what you sort of mean that in economic circles, like anybody who understands economic data, maybe not anyone, but the majority would say, well, you can't, because your mandate is, unless they were to change their mandate, right, which they haven't done. So it's because, cutting rates would be the popular thing to do. There's a lot of people that are experiencing financial stress, but it would be a disaster if they cut rates too early and then inflation took off again and they had to raise rates again. Right? Every central banker in the world probably has nightmares about that happening. So, I don't envy them either. It's a really tough spot. But we're probably, and again, as we said about the US, they're definitely going to go into an easing cycle unless something dramatic changes, probably next year. It's just a question of how quickly and how far they cut rates too. So we're just going to have to wait and see and see what the numbers look like. Are you still suggesting there's a high probability of recession both in Australia and in the US over the next sort of 6-12 months? Jonathan?
I think Australia's pretty much in recession. Obviously
0.3% over 2 quarters, right? 0.3%.
0.2% in the latest quarter. I don't really. We're so close to the zero line, and obviously we know on a per capita basis we've had 5 consecutive quarters now of contraction in GDP. Look, the ABS, the Australian Bureau of Statistics, is coming out with this very fractional level of growth, and that okay, fine. I'm not going to get too worked up about are we going to have a minus here and a positive there. I think we're right around the flat line here in terms of growth, and just talking to just everyday Australians and small businesses here. I have so many people say to me it's worse than 2008 in terms of general sentiment, particularly in the retail sector. So I think we're flatlining here, and we all look forward, as you've implied, to the Reserve Bank cutting rates next year. And will we get a technical definition of a recession, which is two negative quarters of GDP? I don't really know. Obviously, in real in per capita terms, we're obviously there, and we've got the weakest household spending since the early 90s. So it's pretty flat here, I think, in terms of the economy.
And in the US?
Yeah, I mean, the US continues to perform at face value pretty well. And obviously, a lot of this has been driven by the extraordinary government spending. And it's not just at the federal level, it's at the state level. There's really significant fiscal stimulus from state and federal spending that is still flowing through the economy. And I think I still see the economy in the United States weakening as we move forward, because Europe is pretty much in recession. China, I mean, I know we're being recorded, but I'll talk to my China friends and ask them what the actual GDP growth rate is in China, and they say at best 2% and probably flat to slightly minus, and yet the official figures are at 5%. So you can pick whatever number you want with regard to China, but it's certainly not 5%. So the global environment is pretty soft. It's a pretty soft global economic environment. And in the United States, I see a soft environment as well. I think the jobs market is a lot weaker than the official figures tell us. And we know consumer spending now is beginning to falter in the United States. The upper ends obviously continue to spend, happy days, but the lower income and middle income groups are hurting quite significantly. So I think the United States slows down, continues to slow down through the balance of this year and into next. Again, if we get a technical recession, two consecutive quarters, I don't know if it's going to be two consecutive negative quarters, but I'm officially saying that I see recession in the United States in the next 12 months.
Okay. All right, good. I mean, not good, but it is what it is, All right. And then let's now have a chat about what you see in terms of equity and bond markets at a high level, and then we'll finish off by talking about what lifespan portfolios have done over the last 3 months or so, and what the outlook is in terms of the portfolios. What are the things that we're looking at going forward? So, Jonathan, what are your thoughts around the equity markets first off?
My latest report, and we've also been discussing it, Eugene, obviously within the investment committee for some time now, that there's going to be probably better performance from smaller companies moving ahead, and Lifespan has been allocating to the smaller company sector within portfolios. I think there's investment merit to that strategy and to that allocation, and more recently been writing about that in my pain report as well. I mean, global institutional money managers are underweight smaller companies because smaller companies have been underperforming so-called larger companies for some considerable time now. And so I think there's going to be some kind of reallocation towards smaller companies, and that's being obviously reflected in the Lifespan portfolio. So the interesting thing is, if you look at the performance of the US equity indices, in fact, those kind of so-called Magnificent Seven have been relatively underperforming in the last few months. And also interesting that the NASDAQ 100, which was, powered this US equity rally, that still is beneath its July 11th highs. So we haven't made new highs there. The Russell 2000, which is obviously the US equity index that measures the performance of smaller companies, I think that could outperform over the next 3 to 6 months. And if I'm right about Trump winning, I think it will outperform. So I think there's investment merit to, in terms of portfolio construction, looking to allocate towards smaller companies.
Yeah, absolutely. But overall, I think it's fair to say there's still a significant possibility of of volatility in the equity market. So whilst we're not as bearish as we were maybe a year or so ago, it's still worth being cautious, and it's
Yeah.
still a high. There's still a high chance of significant volatility. Would that be a fair assessment?
I think certainly. I mean, we had our opening discussion was about the US election, and then we moved on to the Middle East. I mean, both those events have the
Yeah,
potential to ignite significant volatility. Of the two, the worst one, of course, is the Middle East, and heaven
yeah,
forbid we get something too catastrophic.
yeah,
But also valuations, obviously, are still on the expensive side. So if
yeah.
you're looking at the big picture and you're looking at the world through the prism of being a long-term investor, when valuations are right up there in the top decile of historical valuations, you by nature and through discipline have to pare it back a little bit, and valuations in the United States are stretched relative to history and relative to the rest of the world. But within the US equities, you can make an argument that smaller companies are going to be favored in a valuation and a relative underinvestment factor as well. So
Yeah, and
that's the way I
that's
think
the
about it.
interesting phenomena that we're seeing in equity markets. That you've got, on a valuation point of view, if you look at averages, and if you look at some of the mega companies, valuations are pretty stretched. But when you look at other pockets, actually the valuations don't look as bad, particularly when you look at small and mid cap US equities and global small and mid caps. Even in Australia, I think we could agree that valuations of large caps are pretty stretched. We haven't got time to talk about the banks, but they've come back a little bit, I think, recently, bank valuations. But so yeah, there's always risks out there. It's probably important that our viewers understand there's always risks. You're never going to have an investment environment without risk. It's a question of trying to understand how significant those risks are, how well priced they are in equity markets, and then looking at valuations. If everything's very risky but valuations are cheap and stocks are cheap, well, you're probably less worried about.
Right.
So anyway, so that's where we're at in terms of equities, but obviously it can all change very quickly if one of these issues that we're talking about,
Yeah.
starts to ramp up. And in terms of bonds, we've spoken that we're fairly neutral, and you've been fairly neutral on bonds. And when we talk about bonds, we're talking about long-term fixed duration bonds, government bonds. But we've actually seen an uptick in bond yields over the last couple of weeks, or even less than that, more recently than that, and that's largely due to some of the inflation numbers that have been a bit surprising on the upside. You're still maintaining a sort of neutral feel on bonds?
Yeah, I hate being neutral on anything, but I can't get excited about bonds really. I mean, we've had some really big moves. Obviously, you remember very well October 2023. We saw 10-year bond yields in the United States, heading up to 5, and then we saw yields declining very, very sharply. Then we kind of spiked up, then we went down, and now just latterly, as you say, in the last week, it's about 10 days, isn't it, Eugene? I mean, it's only the last couple of weeks we've seen this fairly significant increase in bond yields, particularly in the United States. I am neutral. The big picture, we all know that America has these very, very high levels of debt, continuing high budget deficits, and to finance those budget deficits, the US Treasury has to issue a lot of US Treasury securities to finance the budget deficit. And so, therefore, all things equal, with the Fed easing monetary policy, lowering interest rates, and the US government borrowing lots of debt, issuing lots of securities to finance that debt, you're going to shift the yield curve upwards. It's going to steepen.
Yeah.
And that's the really big picture direction, I think. Relatively low or lower short-term bond yields in the United States, but the longer end of the market is going to constantly be buffeted by the issuance of treasury securities to finance that big budget deficit.
Okay. So moving on now, just to talk quickly about, we started talking about the lifespan portfolios earlier, and just to sort of close the loop on that. So we have added an exposure to global small caps, actually global small and mid caps. So it's a manager that will invest in both small and mid cap global equities. So we added that over the last few months, and we may add to that exposure down the track. And we've spoken about why. So we believe there's an opportunity there. We took some of that exposure out of large cap, but also some out of emerging markets, so as not to increase the risk too much. In the tactical portfolios, we actually added that exposure, and at the same time, we increased our growth allocation. Whereas in the strategic portfolios, as I said, we took that out of emerging markets and large cap equity, so we didn't actually increase our growth exposure. They were the main changes we made in the last quarter. We are researching and looking to make a few other changes. We're looking most likely to add to property and infrastructure, and that's we feel as though a lot of the headwinds that sector have had have played out and or been priced into listed property and infrastructure. You've got to be very careful when investing in property and infrastructure. If you're investing in unlisted assets, it takes a lot longer for headwinds and other risks to actually flow into those asset prices. Whereas when they're listed on stock exchanges, they flow through much more quickly. So we think a lot of that's priced in. Plus, interest rate cuts are a tailwind for those asset classes. So we think, all things considered, we've been underweight those asset classes for a while, particularly property, not so much infrastructure, but we haven't had an allocation to global property. We've had an allocation to Australian property, but it's been small. So we're looking to increase that in strategic and possibly in tactical as well. And we're also looking to add an allocation to global REITs. And we're also reviewing our managers in that space. We're also looking to make a few changes in global equities to our manager selection. But we're just finalising our analysis on that and making a few decisions. Some of those changes are actually happening this week. Others will happen over the next few months. And we're also making some changes to our Australian small cap managers. Again, that's going to happen this week. And we'll talk about that a little bit more in our next update. But that's just a snapshot of our thinking and what we've done the last 3 months and what we're looking over the next 3 months leading into the end of the year and early next year. So with that, we might leave it there. We've had covered a lot of ground today. It's been a wonderful discussion. Thank you again, Jonathan, for joining us and for your insights. Thank you, everybody, for tuning in. And we'll see you next time.
Thank you, Eugene.
Thanks, Jonathan. Thanks, everyone.
Thank you.